Ben, Apple was the stalwart. It was the one of the big mega cap stocks that have been acting best and holding up better than the rest. Is today's move a sign of something, that it's actually sliding harder now?
Hi, Sarah. Yeah, there's certainly a risk-off sentiment building, including around these type of behemoth stocks. And I think, again, if you take the CPI data at face value, it's not really moderating the way you would like to see. So the bond market continues to slowly pull forward more rate hikes for this year to get the Fed funds rate up more than 2%, probably maybe closer to 3%. And then you get stocks like Apple get hit because it's such a crowded stock and because it's actually a really good company. But really, it's the environment that we're in of having to go to restrictive policy by the Federal Reserve.
Is that what's going on here, Peter, do you think? Because it is notable that the 10-year yield is actually lower today. There's buying of bonds, which typically doesn't happen on these bets that the Fed is going to have to be more aggressive.
Yeah, well, interestingly enough, my view is that, 10-year yields were going to be capped because of what we're seeing here, which is that when equities sell off, normally speaking, and in the absence of a Fed taper, you would have a flight of capital into safety. And we saw that in 2018, in fact. And I think we're going to get a very similar dynamic on a go-forward basis, which is to say the Fed is actually not going to get to 3%, which is the 2023 terminal rate that most big banks are talking about, precisely because equities, and I do believe as well the real economy, are going to see the tightening that happens because of equities themselves. And that equity market tightening is going to do most of the Fed's work for it, which is going to force it to pivot, especially if we get an inversion of the yield curve. For example, if the Fed gets to 2% and the 10-year is at 1.5%, that inverted yield curve is going to send a very strong signal to the Fed that it needs to slow the pace of hikes. So I don't think today's CPI print changed very much at all. Fed's going to go 50, and at some point, Fed is going to realize it was late to the party, and it's going to have to leave early.
Well, so if that's the case, Peter, then there would be more growth concerns out there, which may be factoring in. And then wouldn't you want to own big cap tech like an Apple or a Tesla, which are growth stocks that typically do well in low growth environments?
Well, Sarah, I think at a certain point you're going to want to buy a lot of these names. I just think we're 10 to 15% too early on the indices. PEs still need to adjust. We're at 21 times, very aggressive forward earnings. Earnings for next year are going to suffer. We are going to see a growth slowdown. And typically, equity markets overdo it to the upside and they overdo it to the downside. So our view here is that we have a little bit more pain in the indices. As you know, I think it's a sell the rally market.